This is breaking news. You've joined us for live coverage of the outcome of the two-day FOMC meet. As expected, the Fed has left its rates unchanged. And of course, the focus now remains on the press conference that begins in about 30 minutes from now. And as we head into that important event and, of course, wait for the fine print of that FOMC statement to hit our screens, let's quickly look at 5 things that you should be looking out for in this all-important press conference. Number 1 will be the outlook for the U.S. economy. Now, remember, most believe that U.S. GDP growth is expected to rebound after that reading of 0.5% in the first quarter, and so hopefully things will look up in the second quarter. The other big thing is, of course, going to be the jobs market strength. Remember, you had a jobs shocker in May. Was it a one-off or the start of a worrisome trend? That is something that we will wait to hear from Ms. Yellen. Now, nudging $50 a barrel, what's the inflation outlook for the U.S.? And last but not the least, something that we know Ms. Yellen has remained pretty tight-lipped on most occasions is a roadmap for possible rate hikes. Keeping all of that in mind, a good time for me to also welcome on board a stellar panel that joins in to discuss all of that with us over the next 30 minutes. I've got Priya Mishra of TD Securities joining in on the phone line. Crossbridge Capital's Manish Singh is here with us. Hugh Johnson of Hugh Johnson Advisors. I've got Byrne of WSNM and Seth Freeman of EM Capital joins in as well. All of you, thank you so much for taking time out for us. And Thomas, I'll actually take it to you first. As expected, the Fed has decided to leave rates unchanged. But the fact remains that the odds of a June rate hike had plunged already because of that shocker jobs report that you saw, where the U.S. has added just 38,000 jobs in May. Would you say that this is a one-off blip or perhaps the start of a worrisome trend? And to what extent do you believe it weighed in on the Fed's decision today?
My connection's not very good. I think the Fed, it was not a surprise that the Fed was on hold for this meeting. They're still seeing what now? 2 hikes more in 16 and 3 in 17. I think the Fed's going to be hard pressed to go faster than that. July is probably still a live meeting, but I think we would have to see very strong data or a significant rebound from the weaker jobs numbers we saw for May for them to go at the July meeting, not just because it's a meeting without a press conference, but it's also a meeting during the summer when the markets are very thin, and thin markets breed volatility. So we'd have to see a really sharp rebound for the Fed to go before September. My base case is that we're not going to see data strong enough to go until December after the U.S. election, but September is probably the next most likely. Besides that the Fed would probably raise the Fed funds rate.
Right. Let's take it across to you, Johnson, as well. And hopefully you can hear me better. And I was talking about, how much of you think an impact the jobs shocker played as far as the Fed's decision today is concerned.
There's no question that the very soft jobs number for the month of May that we saw at the beginning of the month was clearly the motivation or the reason that the Fed decided not to raise interest rates. And I agree, it will depend whether they go or not in July will depend very heavily on the June number, which we'll see at the beginning of July before that meeting. So I think that's really what's going to be the issue. So we'll take a look at that number. Let's keep in mind that it's not just the employment numbers, although that's obviously the most important number that Janet Yellen and the members of the committee are going to look at. But also there's lots of other economic numbers. So the numbers we're seeing now, particularly retail sales, consumer spending, which is 70% of our economy, have been pretty good. The expectation is now that it looks as though they were getting that rebound in the economy. We're looking at something like 2.5% growth up from the 0.5, 0.8% growth of the first quarter. So they've got good reason to move towards higher rates in July. But again, I get back to what was already said. That employment report has got to be a good one. In other words, 180 to 200,000 jobs created in the month of June, and that'll be enough to give them the cover to raise rates in July, which they very much want to do.
So what you're saying is that the abysmal 38,000 jobs in May was just a one-off and not the start of any sort of worrisome trend, right?
Yeah, the numbers that I put together say that was a one-off. It's very hard to reconcile that 38,000 number with the ADP report and some of the other reports, such as jobless claims. It's very tough to put them all together, and it seems to me, I don't want to say there's a mistake, but I will say that it's very hard to put them together. The jobless claims numbers, the ADP reports, a couple of technical reports suggest that job growth in the U.S. is a little bit better, certainly than that 38,000.
Okay, as we speak, you've got stocks at least on Wall Street, the Dow and the Nasdaq and the S&P actually pretty much hanging on to the gains. Remember, what we're going to be looking for is the tone and tenor that Ms. Yellen adopts in her press conference, which starts in about 20 minutes from now. But I also have Priya, who's on the phone line now with us. Priya, good evening. And we were talking about how the odds of a rate hike this month, of course, were close to zero. Two panelists believe that perhaps the Fed has a little ammo to go ahead and take that call in July. What's your own sense?
So, we've been calling for the next hike to be in September. My sense from the statement, though, is that they are not. I think they've taken July odds even lower. The market was pricing in about 15% chance for July. I think it's essentially going to go to zero because what you're seeing from the dot plot is the Fed went from one official looking for one hike this year to actually now 6 officials looking for one hike. So if really the Fed or the core of the committee, and we think the Chair Yellen's dot is probably the 5th or 6th dot, so it appears as if at least the leadership is shifting towards one hike this year. If they're really only going to hike once, then there's plenty of time, so they can go in September, they can go in November. I think what the statement appears is some fear around the loss in essentially growth momentum. I think they are not trying to explain it away. They're sort of saying, that the job gains have diminished. And so there's a little bit of fear, I think, from the Fed statement, it appears today, that they're concerned about growth momentum. Surprisingly, they haven't brought up Brexit at all. So actually that tells you that if we do have the Brexit scenario work out, then, that means even lower rates. So the rates market has certainly taken this as a fairly dovish outcome, which is impressive because the market had already priced out hikes for the year. But I think the Fed nervousness around the economic momentum, I think that is fairly evident. And it's going to be interesting in the press conference now, I think, where Chair Yellen will have to, answer questions around, why hike? Was the first hike a mistake? Why is the economy sort of stalling a little bit? So I think it's certainly a dovish message, and the rates market has reacted. The curve is steepened, rates are about 5 basis points lower, which I think makes sense because I'm a little surprised that they've struck such a sort of negative tone in the first paragraph. It's otherwise there haven't been too many changes, but the dot plot changes again this time after the March dot plot, as well as the first paragraph, tells you they're getting a little nervous here.
Right. Thomas, actually, let's talk about that a little bit since we're talking about nervy sentiment. And Priya's made a very valid point that the FOMC statement doesn't seem to have mentioned, fears around whether or not you'll have the UK actually choosing to stay out of the EU. But the fact remains that off late, and if you were to look at it in the last week or so, markets have been very jittery about that. And without a doubt, that's something that the Fed would have, thought about. Is that something you expect Ms. Yellen to address in her press conference later today?
I think she'll be asked the question. That's for certain. But I think if you think about it, the Fed had addressed Brexit in the past when they mentioned international developments. All right, so now the Fed is on the sidelines. I don't think a Brexit would preclude the Fed from going in the future, but they didn't want to go in this month, in June, without knowing what's coming from the UK. So once they know what's happening, which they'll know by the July meeting, the Fed can then either tighten, not tighten, adjust their language, adjust their dot plots accordingly. So I don't think that it was a major concern for this month. I think that was already decided beforehand, and that come July or September, then they'll act accordingly depending on what comes out of the UK.
Right. Okay. Hugh, the other thing is that the Fed has actually gone ahead and lowered its growth forecast for both this year and the next year. Ever so slightly, but nonetheless, they've done that tweak. Would I be absolutely wrong in saying that there seem to be somewhere some renewed fears of a slowdown at home?
Yeah, I think there is. I mean, if we look at the data, and you brought up the jobs data, right? All right, the 38,000 is an outlier. We can agree on that. But if you look at the prior 2 months, we're starting to see a slowdown in hiring. Now, the Verizon strike in the U.S. probably lowered influenced the May number rather down below what it was, but I don't think we can look at jobless claims and say, well, there's the same type of correlation. We've seen the labor force shrink. If the labor force shrinks, your potential for jobless claims shrink. So we're starting to see a slowdown in hiring. Is it a slowdown in the economy? Is it just a maturation of the cycle? Is it demographics lowering the labor force participation rate? If we were really that close to full employment and businesses really needed to find workers, you would see wages spike and/or you'd see even training programs. During most recent economic expansions, when there was a shortage of workers, you'd see all kinds of training programs coming out of the private sector. So it might be that they want qualified workers, but they don't absolutely need them. Take retail sales. We saw a pickup in April and a less of one in May, and that's a good sign. But if you look back the past several years, they're very volatile. Going back to 2014, you saw I think it was October through July, you had up 0.8, 0, up 0.8, then 0. So the numbers are very volatile. And go back to GDP. We're seeing the Atlanta Fed GDP now tracking at 2.8. We're seeing the New York Fed's nowcast tracking at 2.4, right? But when you consider that we printed 0.8 at the second look of Q1, and the second look is usually pretty close to what you get on the last look, that's a kind of muted rebound from a poor first quarter. In recent years, a 0.8 first quarter would probably augur for a 3.5% to 4% Q2 rebound. So I think that's all weighing on the Fed. Not saying that the U.S. economy is heading towards a recession. I don't believe that, but we're probably hitting that mature cycle where the best part of our cyclical growth is behind us.
Let's take it across to you, Johnson. And as Priya was saying, that 6 Fed officials expect one 2016 rate hike versus one that you saw in the month of March. The median estimate continues to forecast 2 2016 rate hikes. Let's presume that, next month in July, when, mind you, there is no press conference, we do not see the Fed go ahead and hike rates. But then that basically means that we're looking at August and September. But do you also not believe that that's a little too close to when you will have the US presidential election campaign sort of, reach its peak? And that's perhaps a time when Ms. Yellen may not want to rock the boat. So are we then looking at a scenario that, Ms. Yellen will perhaps only look to hike rates once America has a new president?
Well, that could be the case, but knowing Janet Yellen as I know Janet Yellen, I doubt that that's going to enter into her thinking. I think she's really thinking about what's the best step or policy move by the Federal Reserve in terms of what's going to help the U.S. economy and maybe help that rate of inflation get towards the 2% target that they have. So I don't think that's going to be a consideration, but it certainly means that if we don't see a rate increase in July, the chances are very strong in September, and that'll be far enough before the election that she'll feel very comfortable she's not interfering with the election. But I don't think that's going to really cross her mind or weigh on her mind as much as the current state of economic affairs, employment conditions, obviously important, as well as the rate of inflation, and then to some extent, international economic affairs, international financial and economic conditions. So I say if July's not there, you're looking at September, and that's probably going to be the only rate increase that we see this year. And that would, of course, be consistent with what we see in the current dot plot.
Priya, let me ask you then, when do you see a rate hike? And do you even see 2 rate hikes at all this year? Are we just looking at one? And do you also believe that the presidential race and the election could complicate things a little bit?
Sure. So I don't think that this Fed is very politically motivated at all. So I think the elections don't matter. As for number of hikes, I think one hike this year, because I do think that this Fed is sort of operating under essentially three mandates. They've got the employment mandate, they've got the inflation mandate, and then they've got this financial conditions mandate. And if they do try and hike twice this year, I think you can get a significant tightening in financial conditions, which can essentially then be a risk to the economy. So I think that precludes two hikes to some extent. As to when the next hike is, we are calling for September. But my biggest concern now with September is the market's now pricing in 20% chance of a September move. I don't think this Fed is going to hike. If the market's only pricing in 20% chance, I think it's going to be too much of a shock. So now they will need to work, and the economy, the economic data will need to improve. But essentially, between now and the September meeting, we'll need the September meeting odds to rise at least to 70-80%. Like historically, the Fed's never moved. If the market's not pricing in, greater than 80% chance of a hike, I think the Fed doesn't hike. So they need to they have their work cut out for them, where they need to move the odds from the current 20% to 80% before they can hike. There's not a lot of time, so you'd need number one, Brexit not to happen. Number two, you'd need the next few payroll reports to come in very strong. You need the economic data to all signal that the economy is ready for a hike. I think that's a little bit of a tall order. So I think it could be a little bit challenging for them to even go in September unless all of this happens. It's going to be hard for the market to price it in. So then expect a decent amount of volatility, because if the Fed wants to go in September and the data is not, giving them a resounding yes, they will need to come in and actually move market pricing. So it's going to be interesting, and I think the Fed is sort of stuck a little bit in this idea where they want to get the market set up, but they don't want the market to overdo it, because then it tightens financial conditions. So they're a little bit, I think, a prism of the market, or sort of stuck with the market here. But no, we are looking for September. I think we're hoping that the data is going to improve in the near term, and that'll allow them to hike. But then that's probably it for the year.
Right. Also, Priya, very quickly, having said that, and if you're actually looking at a September scenario, then what's the outlook for the dollar index? And of course, I'm also asking this because emerging market currencies like the rupee are bound to be impacted. Right now, as we're speaking, you're seeing, the dollar sort of extending losses. Surprisingly, you've seen gold futures. They've hit their highest in actually over 1.5 months. And of course, stocks on Wall Street seem to be sort of hanging on to their gains. But Priya, coming back to the outlook for the dollar index, if the market for now is working with a September scenario.
So if the market does start pricing in that the next hike is going to be September, we think that the dollar is going to strengthen, but it's going to be bound by the fact that they will probably not be able to hike again, and that we've realized that if the dollar strengthens too much, it actually hurts equities, it hurts the economy. So somewhat range bound, if you think of DXY, 97, 98 is sort of the peak. So we're still looking for a stronger dollar from here, because we're looking for a September hike. I think today is just the fact that this Fed sounds very worried about growth. Unless Janet Yellen is able to sort of offset this, I think the dollar certainly weakens today. But if you do get no Brexit and you actually get okay economic data, we think the dollar should strengthen a little bit from here. But it's sort of capped though.
Let's bring Seth Freeman as well on this discussion. He's joining in through a Skype connection. Seth, good evening. Good to have you on the show. Fed, as expected, keeping rates unchanged. They've said that the labor market, they are hopeful, will strengthen. But at the same time, they've sort of slashed the rate hike trajectory. Most on the panel so far believe that we're looking now realistically at a situation when we're going to see a rate move only in September. What do you think?
Well, that seems to be the consensus view. I think one of the key metrics will be inflation, frankly, as much as employment figures.
Okay. We've also got Manish of Crossbridge Capital. And Manish, a quick word on, the fact that, of course, the odds of a rate move this time round were close to zero. From what it looks like, not just the market, but the Fed itself, you could say, is sort of losing faith in itself. So even Fed members believe that you're only possibly going to see one rate hike this time. Do you believe it's going to be September?
Well, I think that it's going to be September, and I entirely agree with the fact that there's probably going to be only one rate rise. I mean, as you've seen that in the statement itself, they're talking about lower growth expectation and lower inflation expectation. Now, I'm not entirely convinced about the lower inflation expectation because the labor market is tightening. And my big fear is that by the end of the year, U.S. may be entering into a stagflation scenario where you have lower growth because obviously there's no fiscal response. Monetary policy can do just as much. And as later labor conditions tighten, then you might have some inflationary pressure, which will be welcome initially, but I hope it does not lead into stagflation. That's my fear. I don't see it playing out immediately, probably end of the year, Q1, but that will be my fear.
Okay. Manish, what do you think is holding the Fed back? I mean, we've discussed before you joined in on the show that this one-off abysmal jobs report definitely isn't. You're seeing growth somewhat pick up. Do you believe then that to some extent it could be the global risks that await, for example, Brexit, which in your part of the world I know has, really come up as a big source of worry?
I would say it's not just international risk. Obviously, international risk is something that Fed always bears in mind, and Brexit will be playing on Fed's mind, at least at this decision. But I think it also comes down to we are really talking about growth scenario. We are talking about consumption increasing. We are talking about real GDP growth. And those are concerns, which should be on top of Fed's mind. Because think about this, we had QE, and QE has done its job of preventing a 1930s-like depression. But QE alone cannot bring back growth. Growth has to come from additional fiscal measure because clearly monetary policy has run out. I don't believe negative interest rate policy is helping anyone. And I think it's just taking people away from looking at what is the real problem in the economy. Mm-hmm. The real problem in the economy is of demand. Supply side measures are not going to take care of that. So demand really has to be addressed and demand has to be injected into the economy. Now, as you see in U.S., nothing happens on the demand side unless the U.S. election is over and the new government comes in. So you are left with this 6 months where you are not going to see reasonable growth. That will make the Fed very wary. And therefore, I think that they are not going to go down the path of trying to increase rates and then try to unwind that same policy which you saw ECB Tricia did in the big crisis. And therefore, I think Fed is going to be very, very careful. To me, at the end of the day, it is all about growth. I think growth, we have seen this recovery since 2009. We really have to see robust GDP growth, and we are not seeing that big number.
Okay. Seth, let's get the India, impact, as it were. Let's presume that we do not see the Fed now tinker with rates all the way till September. What does that really mean from an India standpoint?
Well, I think from a foreign investor's view on India, the fact that rates are not increasing is positive. I think we saw that last night or today in India in the local market. The cost of investing and the risks of investing are perceived to be lower. But a lot of it does depend on Indian domestic policy, the overhang of NPLs and NPAs, and also the general direction of inflation. And of course, everyone seems to focus heavily on the near and midterm impact of a solid monsoon and so forth. So those policy risks and sort of exogenous risks are still there, but it's much easier to allocate money to emerging markets when alternative investment ideas are not having good yields.
Okay. Hugh Johnson is here with us, and Hugh, we appreciate you waiting by patiently. Minutes to go for Janet Yellen's press conference. Very quickly, do tell us what you will sort of have your eyes and ears open for.
With Janet Yellen, I think she's going to be asked the question, as somebody else said, about Brexit. So we'll get a little bit of an idea, or a more fuller idea, of what the Fed is doing as far as thinking about international affairs. We'll also get a very specific idea as to whether she does think that employment report, as I think, and I think many others think, was a one-time aberration. And I think we'll get a really good sense as to whether they will start to move towards increasing rates, maybe as early as July. I understand that the most sensible forecast right now is that September, and that will be it. But I think she's going to tell us a lot more about what their thinking is on the U.S. economy, employment on the one side, consumption, which is good, on the other side, the rebound, whether it's satisfactory, 2.5%, and the rate of inflation, as has been mentioned. Let's not forget the rate of inflation is now picking up in the U.S., and so that that also will be discussed in a little bit more detail. She'll give us a comprehensive picture, and we'll get a better idea as to whether they're even considering July or whether it's off the table. I think she'll leave it on the table. And of course, I think, as I mentioned, the most sensible thing is to expect or forecast that they'll raise rates in September, and that will probably be it for the year. But that consensus forecast and my forecast, that can change with the next set of numbers that comes out.
Seth, do you believe it's actually going to be that easy? Because it's always a guessing game, right, when it comes to the Fed's press conference. So do you actually believe that she's going to sort of lay it out there and say that, look, we don't see ourselves moving till September?
Well, I was just scanning the press, before coming on the air, and try to quickly look at the Fed minutes. No, it's very complicated. There's other factors that have to be considered in terms of the Chinese RMB devaluation that's hanging out there. I want to make a point about the labor statistics. These labor statistics are not a one-off indicator, but the previous two reports were actually reduced dramatically. The employment figures were revised downward dramatically. So this is really part of a trend. And I don't see that the labor market is as tight as perceived. There are so many people who have literally stopped looking and not participating in the unemployment numbers. I see those people coming back in the market long before we really see inflationary wages.
Manish, just time for quick comments on what's expected. But I also want to just, actually Seth, I think amongst everybody that we've spoken to this evening believes that the 38,000, job addition in May is actually not a one-off, but it could actually be the start of a worrisome trend. Manish, would you sort of, back that argument? And also, before we let you go, walk us through what you're expecting to hear from Ms. Yellen later today.
Sure. So what I would say that, and this is something is very well known, that US needs to generate only 70 to 80,000 jobs per month for the unemployment rate to remain stable. And US has been doing a good job of getting 150, 200,000 jobs, as you see in previous reports, except the last one. So there is some softness in the job market that is not ruled out, and which exactly makes the case that Fed is not going to be in the rush to raise rates. So I think that is number one. Second is that clearly the question on Brexit is going to come up in what Janet Yellen is going to talk about. But for me, it's also about questions around growth. And the reason I keep saying this all the time, because, we have discussed about monetary policy a lot, and monetary policy has done its job. We really need to think about, where the real GDP growth is going to come from and what is that real GDP growth rate. I mean, clearly we're not going to get 4 or 5% in which everyone was used to in recovery, in the past recoveries. Maybe it has set down to a lower number. And if it's set down to a lower number, your normal real rates are also going to be lower. So your cycle, the rate hike cycle this time around, I'm afraid may just peak at, let's say, 1% with 2 rate hikes before you see a cyclical recession. So these are the kind of things, which I think about. If we are in later stage of recovery, then maybe, we have recession next year at some point. Then this rate hike cycle can peak at 1%, it is likely. So I would like to hear things around growth, what Fed thinks, how lack of fiscal policy is impacting that. Clearly, they are not going to make a political statement, but I would like to see those things being addressed, and things around inflation, because clearly the opinion is divided in a sense that you do see 2.5% wage growth. You see a tightening of the job market. Maybe there's more slack, and I hope there's more slack. Otherwise, clearly we run into problem. But otherwise, you will see that you have inflationary pressure building up when actually you do not have great GDP growth, and you do not have huge amount of consumption coming from job creation. So these are the things I would look for in a press conference. And of course, let's see what she says, or if anybody asks her a question around Brexit.
Right. So Manish, so basically what you're saying is that, these renewed fears of a possible slowdown in the US are not completely unfounded.
No, I think that is a bigger news. To be honest, to me, Brexit is not as big a scare story as people are making it out to be.
Yeah.
To me, it is more about cyclical growth, both in US, in Europe as well, because you are really, really not seeing any response from fiscal side, and monetary policy has run out completely. You are at zero rates, you are at very low rates in Europe as well, and you're not seeing GDP growth catching up. And to me, that is a bigger cyclical story that, are we heading into a stagnation or very low growth environment, and the impact of that on asset prices.
Manish, from the last time that we chatted about this, actually, you didn't sound all that bearish. So, sort of what has changed in the last 2 months or so for you to now have this opinion?
Sure. So let me tell you, I don't want to sound over bearish because I am not one of the believer of secular stagnation story. I just like to see an answer that why it will not happen, or when we get there, what the fiscal response will be.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.